Types of insurance flashcards. What is covered by commercial property insurance? Commercial property insurance covers fire, vandalism, theft, when building contents such as furniture and equipment is at risk, physical structures, and materials used during business operations. These are all covered by commercial property insurance. What is covered by general liability insurance? General liability insurance provides protection from bodily injury, personal injury. For example, if someone comes to your office, slips and falls, this insurance would protect you. It also covers for property damage. A contractor would have general liability insurance for a construction site, and an architect would have general liability insurance for their office. What is covered by workers' compensation? Workers' compensation covers medical expenses and lost wages for employees who become sick or injured at work. This is one of two types of insurance that is mandatory in California. What is covered by automobile insurance? Automobile insurance protects against physical damage or bodily injury that results from traffic collisions or any incident involving a vehicle. This is also another type of insurance that is mandatory for all businesses to have in California. What is covered by errors and omissions insurance? Errors and omissions, or E&O, provides protection against claims of negligence or failure to deliver professional services as indicated. E&O insurance is typically purchased by the architect. What is covered by builder's risk insurance? Builder's risk insurance is normally purchased by the contractor, who lists the owner as a co-insured person on the insurance. It provides protection for buildings under construction from claims for property damage, theft, vandalism, and fire. What is covered by inland marine insurance? Inland marine insurance provides coverage for movable tools, materials, and equipment that is rented or owned. It covers equipment also during transit to a job site. What is covered by surety bonds? Surety bonds are also known as performance bonds. Performance bonds cover financial compensation if the contractor fails to fulfill the project obligations with a construction agreement. In that case, the surety company or the performance bond would cover that failure to fulfill the project and would step in and complete the project per the contract. What types of bonds are carried by a contractor? The first is a bid bond. A contract bond that provides financial protection to the owner and ensures compensation if the bidder doesn't start the project. Next, a payment bond, which is a financial guarantee that a contractor will pay their subs, laborers, and material suppliers. The contractor purchases from a surety company before the start of a construction project. Next is the performance bond, which is also known as a contract bond, is a financial guarantee that the contractor will fulfill their obligations. It's provided by a surety company that is purchased by the contractor before starting a construction project. When is bonding required? Bonding is required for when general contractors own expensive and larger heavy equipment or for high capital projects. It can be required by government projects or high value projects where contract prices are guaranteed by the contractor. Private owners on smaller projects might not need or even be able to afford this expenditure. Some jurisdictions, however, will require bonding as a prerequisite to obtaining a contractor's license. What are ways to mitigate risks on development projects, especially for owners? including a generous contingency in budgets and schedules. Obtaining adequate insurance, including builder's risk, property insurance, liability insurance, and bonds from the builder and subs. And not becoming financially committed until all major risks are fully mitigated. What is common when it comes to builder's risk policy? If the public agency owner purchases the builder's risk policy, the owner pays for it at its cost. If the owner has the architect specify that the builder purchased the policy, the owner still pays for it because the builder just taxed the cost plus overhead and profit onto the base cost of the policy. Therefore, it is cheaper if the owner purchases it directly.